Hey, what's going on, guys? Welcome to this video. This is Chris from Virillo Trading. Let's do a video now. So I received a good suggestion from a viewer. This is the topic: how to approach a bad trading day / period. A bad trading period. How to approach it. What can you do when you're having a bad day, a bad week, a bad month, a bad year? I don't know. Let's get to it. Let's talk about it seriously here from the perspective of a trader who has had bad days and bad months. It's all part of the learning process. If you enjoyed this content, leave a like on the video. Let's get to it right now. I'm just gonna go with what I'm thinking, and then I'm gonna edit the video later. So if some of this sounds chopped, then it's because it is. So the thing with trading, guys, is that you first need to understand is that there's a lot of BS about there about what is good and what's not good, what you should do, what you shouldn't do. If you're in an industry where there's a lot of misinformation, it's going to be very easy to make subjective decisions and subjectively review your results as well. You're not reviewing your results from something that can actually help you in the long run here. So how do we approach a bad trading day? So I'm gonna assume that you have something that is working. You have what I would define as a statistical edge in the market. You have identified something that works more often than it doesn't. You also understand what conditions this works in and what conditions it does not perform in. Like you've probably heard me and other traders say, is that there's no perfect strategy, and it's all about applying the right approach for the market condition that we're experiencing on a given day. I want you to know, first of all, I am no master here, okay? I'm an experienced trader, but I'm not a master. There are traders who have years ahead of me on this who would probably make a better video because I feel like making the video. That's it. All right. So you approach a day, so you take a trade, you get filled in an order, you scratch it, or maybe it's a loss. Maybe it went through your stop. So for example, my first trade of the day today, I bid at a price, I had the edge for a second, and then there was a big sweep that took me out of the trade. Now, obviously, I couldn't predict that sweep. It was just a random occurrence, and it happens. Because remember, you're in a probability environment, and you do not know what is going to happen next. All you know is that you're executing a statistical edge, and you have to do it consistently. Now, there are days that will not be right for whatever you're trying to do, and those are days where you essentially need to minimize the damage. If you're already starting to see signs of a day that could potentially be on the choppy, low volume side, and you know that you don't trade well in that condition, then you may as well call it quits early, unless you feel like you're willing to wait for something that might work for you. Now, for example, let's say you trade a session like that and you're having limited success. You know, you take 3 trades, all of them are losers, or maybe 2 losses and a scratch. Then you take another one and it's a scratch. You take another one and it hits your stop. That's an example of a session where the trader is certainly having a hard time gauging the market condition, and what you're doing is simply not right for the market condition. That's what you need to understand and be honest with yourself about that. You know, there could be other reasons as to why you're doing bad on a given day. I would say the majority of time it's because you're doing something that is not right for the current market condition, or you're just simply not seeing it, which is the same thing. Now, the thing would be, how do you approach this? Well, it's simple. You stop and you wait for the conditions to be better. For example, today, April 5th, market was pretty slow. It was that slow grind up, and it's very easy to get chopped up. You have to have good tools at your disposal and some experience in these markets to know that when we have a day like this today, you don't even think about shorting. And some of you are going to say, well, it's easy to say that in hindsight. But actually, look, if you understand a bit of market profile and you understand how the market behaves when it's at all-time highs, then you would know, don't even think about shorting. I'm speaking from the perspective of look at the market, bid and ask, read the tape, bid or offer type of thing. So, you know, when you have these kind of one-sided days, you have to be very nimble if you're looking to take the opposite side of that trend, and that's basically it. Back to this topic here, how to approach a bad day. Well, look, a bad day is one thing, and there's different kinds of bad days. There's the kind of bad day where you go into a session and you have 3 losers in a row, you know the conditions are not right for you, and you stop. And you say, all right, I'm going to come back later because this is not my market, for example. Another type of day would be a day that you're kind of chopping around, you're breaking even, right? So you have 1 win, 1 loss. 1 win, 1 scratch, 1 win, 1 loss, that type of day. And you look at your P&L and you're slightly up, slightly flat. Those are days where probably, again, the conditions are changing a lot, not a lot of clarity in the market, probably a lower volume, lower participation type of day. And again, what you're doing is you're sitting there trying to bang out trades in a market condition that is not fitting what you're doing, and you're probably over trading it as well. There's actually a significant difference between those two types of days. The first day being where you just lose and you realize this condition is not right for what you're looking for. And number two, which is you're kind of just breaking even on the day. I would say the days that you're just breaking even, just getting by, those are much more frustrating because you find yourself sitting at the desk after a few hours and you look at your P&L and you're just right around flat, maybe slightly up or slightly down. Those days are much more frustrating, and that's why I believe that trading should never be your primary source of income, because psychologically it is hard to deal with, especially when you have to deal with a lot of those type of days where your goal is essentially to minimize the damage more than it is to have big profits. There's a saying that says day traders make the most of their money on days where they're making money. The rest of the time, their goal is essentially to minimize the damage. And then of course, if you're having a bad trading period, so let's say you have multiple days in a row where you're experiencing losses. And again, guys, it is subjective because I'm speaking from the perspective of a scalper, right? So if you do have multiple days in a row where you're losing money, you're probably not trading right for the market environment at all, and you should probably take some time to study the conditions a little bit more and potentially learn to apply something that would work a little better in these conditions, aka you're not doing it right. In that case, you should definitely seek out a mentor who is consistently profitable in these conditions. And that being said, nothing is perfect. There are a number of trading principles that experienced traders use to give themselves an edge on a consistent basis that help them to filter out for high probability opportunities. Now, a couple of things you can do that can help your overall performance and help you understand whether what you're doing is working or not. The first thing would be journaling your trades and reviewing your results day to day and at the end of every week and at the end of every month. Now, when I say journal your trades, there are a few important pieces of data that you need for a scalper primarily here. You definitely want to be able to go back and look at the recording of your screen to see what the market was doing and the overall context when you were taking these trades. And the other important data would be the metrics involving your trade, which are how onside your trades were, how offside your trades were before you closed them, how much profit you locked in on each of these trades, the market environment that was present when you took these trades, time spent in each of these trades, all of which are important inputs that should go into understanding what kind of trading method you are employing for whatever kind of day you're getting. Now, I would say, look, if you're a higher frequency trader, like a scalper, you don't have to necessarily review every single one of your trades all the time, because look, if you take 100 trades in a week and you spend time reviewing every single one of them, that's a lot of time consuming work. There is something to be learned from a lot of trades you take. I would say maybe not all of them, because there are some sessions that are really easy for certain traders. They trade in a way where their strategies are giving them edge, and then on other days they try to trade the same way and all of a sudden they struggle to even make a few ticks out of the market. And that's just simply how it works. You should definitely review your trading from the perspective of trying to understand what kind of methods you're using based on what kind of market condition we're in. You can see it very clearly in your P&L. So if your P&L is all choppy and you look at the session, you can probably make an objective analysis and say something like, I was over trading a market that clearly had less opportunities than I thought there were. I simply wanted to trade for the sake of trading. And of course, you should know that that is not a profitable approach. Another way that traders can mitigate damage to themselves and their trading accounts is simply by analyzing how trading fits in to their overall lifestyle and balance, especially if you do day trading. Trading is a high performance activity. It requires you to be in shape mentally, physically, on a consistent basis. So one thing you can do if you are experiencing a hard time in the markets is take a look at how trading fits into your overall lifestyle and see if there's anything there that you could potentially improve on. I like to keep a relatively balanced routine schedule when it comes to exercising, eating well, sleeping enough, and basically stay in shape to do the same thing every day. Now, that being said, if I was trading badly, I would certainly pay a little bit more attention to the choices I make when it comes to choosing my strategies for each individual market condition. And again, getting back to the lifestyle thing, guys, too much of anything is certainly no good. So if you definitely find yourself in front of the screen for way too many hours on days where the market is simply not giving, let me tell you, you're doing it wrong. You want to be there when the market is good. And when it is good, guess what? You have to stay there. That's one problem traders have, is that when they're profitable on a day, they're happy to just stop. In reality, when you're profitable, you have to stick around and ride it for all it's worth and keep banging the trades out as they come through. From experience, when the market's being good to you on a day and you're seeing it right, continue to bang it out. On days where the market's slow and not right for what you're looking for, quite frankly, not right for almost anything in regards to scalping, that is, you're better off just turning off the screen and go play basketball or something and do something else, basically. So that's what I'm getting at, guys. So if you guys have any further points you'd like to add, feel free to leave them in the comments below. Also, I'd love to hear your thoughts about this in the comments below. This was a question from a viewer. I thought I would make a video talking about it a little bit. I wish you guys all the best, and I'll catch you soon. Take care. Bye.